Hi, Safir. So,
Hi, good evening, everybody.
so happy to have you. I know we had planned a space in January only, and then now spontaneously, like magic, it happened.
Well, last night I was not scheduled to speak, but I joined the room and then they requested me to speak. And then, it turned out that the interest of people, based on the logic that I was trying to advance, was appreciated. So I just felt that if it's helping somebody, then why not? Because yesterday there was a sort of a semi panic situation where people were very worried about this 15% fall in Russia. And it was a very nice discussion that we were trying to have to explain to people that a 15% drop in Russia is not necessarily going to cause a catastrophe. Of course, you cannot control what market does at the open, but there are a lot of factors which were Russia specific, which people did not have to extrapolate into an Indian market crack of the same nature. That's not to say that we're not following. We are following and we're getting beaten by our mid caps and small caps, but be that as it may, it's all part of investing.
Absolutely, absolutely. So, how would you, how would you say that investors right now can keep their nerves calm, and how are you looking at your own portfolio right now?
So I can only talk about what I am thinking in my mind, and obviously with the standard disclosure that what I think in my mind applies to me and my temperament and my. I may have a different sort of patience level. I may have a different level of detachment to stocks, etc. But having said that, somebody who tries to do the same may have to factor in his own circumstances, and it's a lot of mind game. Yeah, stock investing, according to me, is a lot of, at least fundamental investing when markets get rattled, is a big game of steel. Whereas it's very different in a bull market where you can buy junk also, and it will, and you would, even junk moves up, and you can get very complacent with the fact that you've struck gold. So in bull markets, we do not distinguish between gold and what is not so good. I don't really mean junk, but some things are which are not so good. Sometimes we also mess up big time on valuations. But when the markets correct like they have, they do afford a lot of opportunity across to sort of relook at your portfolio, to realign the portfolio from a perspective of what lies ahead, because whatever has fallen, but what is critical is what lies ahead, and to sort of make the next move. So what has actually happened is that there are uh, three different sets of investors, according to me, in the market right now. So the first set of investors are investors who have last 2 years played an extremely safe sort of investing game. I'm not calling it a game in a real game sense, but I meant a strategy. And I'm not necessarily, at least I was not in that camp, because I don't believe that just ownership of defensives itself is a defense. The ownership of defensives is a defense when the market corrects, because obviously defensive stocks by definition do not fall in conjunction with what the market falls. But they also, in order for them to yield capital appreciation, which is the crux of investing, there has to be some element of growth in them commensurate to their value. Growth by itself may have a very bad impact on valuation if there is a disconnect. For example, and also the concept of growth today is very varies a lot. Somebody says growth is getting more clients. It happened in the dot-com crash when people kept saying that we've got more eyeballs. Somebody says growth is the discovery of a new molecule in pharmaceuticals. Somebody says it is a bagging of an order and the transformation of what it will do. Somebody says it is a sectorial headwind, or in some cases headwind, in some cases tailwinds. So it's a very relative concept. But what is basically happening, in my assessment, is that the defensives are actually broken into two parts. There are defensives that are holding out because of legacy issues, and there are defensives, for example, say some consumer names are holding out because of their history of sort of having done whatever they have done. But if you actually see, barring one or two names there, even those stocks have corrected. I'll give you an example of something that I did, and again, it's only from personal experience. I'm not a SEBI registered advisor. It's only my personal experience. Had exited Hindustan Unilever, a company that I immensely respect, and it's like a role model company, not from a investing perspective, but for the sheer genius that the company is. But I felt at a price above 2,800, it looked to me that the company had squeezed out all the efficiencies that came in from the COVID lockdown and the move toward digital. They were way more advanced in digital. They had organized the retail very well. They had tackled supply side issues far better. They had been able to ensure that their products had reached out because of multi-locational plants during the COVID, when lockdown, etc., happened. So there were efficiencies that came, and that trade, for example, when I say trade, in my lingo, it always means investing, worked out well till the time when I felt that now the valuations have caught up and there may not be any such operational efficiencies that may come in. At least now, it may come in the next round of disruption, which disruption in consumer can take a few years. Whereas there are other defenses, for example, ITC, that have actually underperformed by far. And if you were just owning these stocks, unless you got your timing so perfect that you bought ITC when the price had cracked to maybe 150 rupees, and you may be then sitting with some profits. But most of the people who have been owning ITC or have bought ITC above 200 levels have actually may have protected themselves from the kind of cracks that the market does see often, but have not really made any capital appreciation. And if you actually see that in the last week itself, ITC has corrected from 235 or 234 odd rupees to what, 215 rupees. So that's a 10% fall in the price of a so yeah, so the second side is the ownership of extreme defensive. I'm calling them extreme defensive because some of those business models, in terms of in terms of their business itself, are facing substantial headwinds. For example, you may be efficient in doing one particular product, and you may be scaling up one. Will not count into this necessarily TCS, although it has been extremely steady and it has been a market outperformer because TCS was also undergoing a buyback. And since today was the last day of the buyback, there has been a very small 4% odd correction in TCS. But even then, it has been a bellwether stock, and it's been a fantastic wealth creator for many people. So some part of your money must go in stability. And why it should go in stability is because the gyrations of the market, or the volatility of the market is so high. Every hour a news is coming from Russia. Every hour the news is becoming extremely difficult to interpret because this is an unprecedented sort of a development. Sometimes you split a country and say are now two parts are moving out. The rest of the world says, I do not recognize it. You go back into treaties. The world says we're going to impose sanctions. Now, in reality, try and understand how difficult this tug of war is. If the world decides to impose sanctions on China, and the world decides to impose sanctions on Russia, the world shrinks also, which is counterproductive to a lot of economies around the world. So it's a very precarious situation where a lot of diplomacy is required, and this makes the task of investing, at least in the short term, extremely difficult and burdensome. Whereas over a longer term period, even if you look at the returns of the market in situations of war, you will find that the returns of the market have been extremely more beneficial over a period. Once you've crossed a 1 to 2 months period, usually the market bounces back. Now, while I will elaborate on the portfolio part, and I was just talking about a certain percentage of your portfolio into defenses, I will tell you that I, as an individual, love reading books on psychology and human behavior. And it is a very interesting thing that when the market falls in a very short window, like it has corrected from January to now, what happens is that every human being tries to become extremely protective, and in the desire to become protective, he gives up the ability to think long term and embraces what is falling least. So therefore, for example, on Twitter, people will say, but Warren Buffett is quoted very frequently when the market falls, and people will then come and say, whatever I owned till yesterday, which were my darling stocks, are no longer darling stocks and I'll buy all defensives. And from tomorrow morning, I'll be the most disciplined investor. But that's not what, neither does, in my interpretation, neither does Buffett say that, nor is that the actual way to behave in the market. What Warren Buffett, according to me, from all the books that I've read on him, and I've read a very large number of books and blogs and articles and letters of 50 years, etc., talks when he talks about margin of safety, it is commensurate to the returns that you're going to get. It does not mean that you cannot dip in the short run. It means that if the opportunity before you is sizable and you have a holding period, that's why he uses the expression forever, and the continues to behave like a good child or a good stock or whatever you want to call it in your portfolio, then because the margin of safety is intact, you will do a good job in terms of capital allocation and continue holding the thing. So my interpretation out of this is he does not qualify and say that companies with stronger moats, because the moat itself is relative to valuation, and moats themselves get destroyed and depleted by innovation and by the emergence of new companies, and that's why the market will always have new heroes, new sectors. A lot of the world class companies have to reinvent themselves. Many of them bow out of Standard and Poor 500, and similarly out of a Nifty and out of a Sensex. So, in a broad sense, first part of the portfolio should be allocated to what you think are leaders, where they have very strong balance sheets, either because of cash or because of the nature of the transformation that is underplay. As an example, in this current market, say, like I gave an example of banks, there are the metal stocks, particularly on the aluminum side, seem to be extremely stable because the world situation appears to be very favorable for companies like Hindalco, Nalco, and whatever other companies are on the non-ferrous side. So you can decide according to according to whatever you are thinking, what percentage you want to put into these defensives. Now, what will the defensives do? If you actually look at the behavior of the market in the last few days, you will discover that a certain group of stocks have fallen way less than the market. I gave you the examples of IT. I'm giving you the examples of companies like Hindalco and Nalco, and there would be many other examples. Even in the chemical side, while the chemical market may have corrected, there may be companies like SRF that are holding relatively strong to the market. Again, these examples are only meant to give you an idea. You don't go by the fact that I'm recommending the skip. I'm only trying to say that make a certain slot of companies that will be stable. If you look at, for example, textile names also, there are companies in the textile sphere which have been very, very stable in this market correction. Why are they stable? Because they may be beneficiaries of China plus one. They may be beneficiaries of the fact that they're completely integrated and therefore are at an advantage to companies based in Bangladesh compared to companies based in Bangladesh or other parts. And also, they may be at the verge of certain, they may be safeguarding themselves from raw material price increases or unnecessary exposure, which is concentrated in only a few buyers that are sort of mitigating the risk. Once you have sorted this part of the portfolio, the second part of the portfolio is to look at very seasoned players. That's what I'm doing. Look at very seasoned players, that is leaders in their respective sectors, who are getting rogered in this market for just the fact that in the quarter or 1 quarter or 2 quarters before, they have actually reported what may be called as a lackluster performance, but in reality is the stress on the raw material side, which appears in some cases to be a temporary problem. So if you are able to identify some of these companies that are otherwise very strong but are right now broken down, as an example, there may be companies that are MNC leaders, and those MNC leaders have also, I'm just giving an example, I'm just, again, don't, I mean, you can exfoliate this too and apply it to many other things, but they may have corrected 20 to 25%, which is a very sizable correction for the kind of technology they have, or the leadership they have, or the pedigree of management they have. The second, and yet they are at the onset in many cases of a capex revival. In some cases, they are beneficiaries of India being a very high focus area for outsourcing as an export hub. If you look at a lot of MNC companies, they will become very strong sources of export in times to come. And not only MNC, a lot of manufacturing companies are in the same basket. I'm just using MNC as an example. And at the same time, they will continue to reward you by both capital allocation skills, as also by enriching you with dividends, and if required, buybacks if the stock sort of doesn't behave well, because the promoter will never sell. So there you also have the benefit of studying PLI, and then you study and you say that, look, there are some of these companies have applied, and you try and see what is the rationale, what do they want to do, why are they wanting to become production bases, do they have an advantage vis-a-vis raw materials. Now, just as an example, I'm not again going to name any stocks. If you actually believe that Make in India is going to do well, then Make in India itself will require a lot of raw materials to do well. So some of the companies may be very well positioned from a raw material perspective. And I'm not saying that I own these stocks. I'm just giving you a thought process. For example, some company maybe, if you look at this particular market, some of the outperformance in this market has come from companies that are actually being able to supply power, or being able to supply, companies like ONGC, and some, whatever the company names exist in those sectors. Again, I didn't want to get into stock specifics. So you look at a second line, and you come and say, here the growth is going to be very good. It will be higher than the GDP growth, and the companies are well positioned because of their uniqueness to do well. So when the market tries to rebound, which inevitably it will, from what level is a matter of debate, but inevitably it will, these companies will be able to give a return on your portfolio which is probably way higher than the defensives. And if the market takes time to rebound, as it has done from 1st of January to now, with this sort of drip by drip fall, when you see a 1% fall, it doesn't sound too much. When you say 1% fall for continuous 7 or 8 or 10 or 12 days, it becomes much more meaningful, because it's also compounding at a lesser level. I mean, the sense of compounding effect of the fall, it keeps getting more bigger and better, bigger, not better, sorry, bigger. So the second line is to have companies in that sphere. The third line of basically investing is to look at companies that are disrupting. Now, some of these companies, that is, they're disrupting, they've had a heavy run up, but the run up, according to you, is real for whatever reason that you've articulated in writing. Whether it is in the form of green energy, whether it is in the form of hydrogen, whether it is in the form of some company that is basically being able to discover something that is very disruptive to the market, etc. If the story of that company is on exponential growth, and like I said, I put a lot of companies into export in that segment. If those companies, because of the high quality of products that some of these companies have, if those companies are in the trajectory that they will be able to grow for a sustained period of time, then that's where a lot of your returns will come. And I'm not the guy who likes to use the word multi-bagger, but you will make substantial returns. So I have right now, at least from my perspective, positioned my portfolio into these three slots. My definition of defensives not only includes, does not necessarily include consumer. I believe that the healthcare sector in India is way better positioned. And while I've held this position in the market right from the time when COVID came, I think people are overreacting to the fact that hospitals and medical related facilities see a drawdown just because COVID is going. In fact, I feel that the earnings will go up. A lot of these people have gone in for capacity expansions, and therefore, if the price is right, which is very critical for you to evaluate, because some correction has happened, or some earning growth has happened, or some interesting development has happened in the company, then you will sustain. And the reason this is also showing up in the prices of some of these companies. Again, if I give you examples, it amounts to a sort of a recommendation or indication of my ownership. But some of these companies are holding up very well, while others have corrected. So I'll talk about the ones that have corrected now rather than the ones that are holding. See, for example, Metropolis or Apollo Hospital may have corrected way more than, or at least illusion, from an illusionary perspective, it looks like they've corrected. But if you actually look at the returns of the stock over a 1 or 2 year period, then the sort of current market price also reflects an outperformance. It doesn't necessarily reflect, at least in the case of a company like Apollo, Max and Fortis and others have actually not even fallen in this entire market crack. They're not even holding, they're not even falling down. So that is the first basket of sort of defensives that are in the healthcare sector. The second are certain companies in the chemical sector that continue to have a unique advantage. They may be monopolies in their way. The monopoly can come either because of the unique chemical compositions they have, or just the size and the scalability that they have accomplished in order to become low cost producers. So one of the reasons why companies, so certain companies like, and again by example SRF etc. are not correcting is because they are right now positioned in a way to grow, which is one of the ways the market gets confused, that should I call the growth company that is able to churn out a lot of cash and has good financials also to sort of degrade itself in this fall, because there'll always be takers. The third are, in the category of defensives, or in the second category of the portfolio, are companies that have a very good feel about the future, because like I said, of capex cycles. Now the capex cycles may be because of expansion that they've undertaken. It may be because of their past debt which they has been completely retired. There are a lot of companies in the market that are actually moved to zero debt, and the sheer savings of the interest rate on those companies will be a huge cash generation that will either go into growth, or it will go and come back to in the form of dividends. So, if you look at it from that perspective, and if you had constructed your portfolio, I'm not trying to hide the fact that the market has fallen, and I'm not trying to hide the fact that a lot of pain maybe have been felt by a lot of people, particularly people who were new entrants to the market compared to people who have been in the market for a longer period of time. Well, actually, sorry, I'm going to correct this. People who could have been in the market for a longer period of time, if they were holding the wrong stocks and they got no returns, for them, the returns of 2020 or 2021 would have also been meaningless. But I'm saying people who otherwise would have made money would be smart enough to see that, the certain part of the portfolio is actually being immune. Now, again, if I look at my top holding, and I'm not going to talk about my holding, but if I look at my top holdings in some of my good companies, or at least ones that I believe have not even corrected 5 to 7% from their highs. Whereas there may be other stocks that I also own which may have corrected even 25%. So, am I going to lose faith in the ones that have fallen 25%? The answer is no, because there is an ideology around them. There is currently, you see, I'll give an example. If there is a person who's sitting in the market and he has, for example, either a leverage and therefore he has to sell. Another person who cannot bear the loss, and he sees the stock fall 20%, and he's totally confused and he starts dumping that stock. It always ends up having a sort of a contagion effect. In today's market, look at the way the market recovered from minus 1150 points on the BSE Sensex to some 300 odd points, but there was hardly any recovery in the mid cap and small caps, or very, very, feeble recovery in the mid cap. So these are all temperament related issues. And therefore, if you look at your holistic portfolio and you say, I've got somebody who's batting for me, somebody who's bowling for me, somebody who's today seems to be knocked out, but is otherwise a person who will come and hit a six or score a home run, then your portfolio is relatively more insulated in the market. Now, let me assure you, we are all humans. We all make mistakes. We all get hit. I don't like to see any dip in my portfolio at all. Even if I've gone up 100%, 200%, 300%, and my portfolio falls 5%, I don't feel very good about it, because I just want to do justice. And the only way I can do justice is to try and become rational at that point of time. Rationality at that point of time, if you're not able to decipher the market, means do nothing. If you are able to deploy money, then deploy money. If you are able to deploy money and you're scared of it, deploy it over a sort of a repeated trance. So do a little bit today, a little bit on another day, a little bit on something, and similarly on rise. So you follow all the good traits of what all these veteran investors, all smart books, etc., have documented. And when the market turns around, it will give you a immense amount of opportunity to again make wealth, because there is a if you just for 1 second remove this world and just look at India, which is not the way you should, but I'm just giving an example, then the situation in India appears to be very conducive to the stock market compounding, at least for the next few years. So I will pause here first because I've spoken non-stop, and I want to ensure that people have digested it. And of course, if they have any specific things to discuss or things now, what was the debate happening last night, and why was it? Why were people reacting so favorably to my talk last night? Because yesterday people were in a sense of mayhem. They had come on chat as if to assume that the market has to open 2000 points down, and then there will be a circuit, and because everybody feels that Russia has gone down 15%, therefore nobody will buy, and they will have no liquidity, etc. So there were many debates that we were trying to have. First of all, why would everybody have to come and dump the stocks? So the first point is that you don't have to dump the stocks because the market was, in their assessment, likely to open weak. The second point was that what was the world going to do? The entire world was going to sit and say we will all do a meltdown of all our global assets in every single asset class, irrespective of everything else, just because every few minutes there's going to be an announcement out of Russia. Thirdly, the Russian currency was not showing the same trends. Neither was oil showing the same trend. Although oil was up only 2% last night, but it was not showing the sort of catastrophe. Neither was the crypto market, which is very, very jittery in certain circumstances. And you've just known that last month there was a sort of a off and on, with Russia first saying we'll ban cryptocurrencies, then saying we are not going to ban. Even that was not showing so much of jitters. So I had to calm people and say, as you know, it's not for me to say what the market level is. I mean, I wish I knew, but reality is I don't. But I came and told them, you really have to do nothing. If you have the money and the market gives you an opportunity in the morning, you can buy whatever pre-decided scripts. Do not come to the market and say, okay, I did not know what I'm going to buy, but just because I saw the screen, I'm going to just jump into a few names because they've fallen. Their fall could be justified. But when you pre-decide, you don't suffer from a bias, because you're not trying to subject your brain to assessment of pre-decided facts. It's not like I've decided that the guy working next to me is not good, so now next morning when I see his draft, I'm going to find if in a matter that he's doing, I'm going to find mistakes only. But when I look at it in a more objective way, and I find that some of the companies that are attuned to my long-term thinking or attuned to an objective that I have in my mind are getting cheaper, then and if I have the money, then I'll buy them. If I don't have the money, I will buy small tokens or I will shift my portfolios. For example, there are certain small caps where you will find that a lot of announcements are being made on QIP. I don't think that's a good sign in this market. If at this point of time these small caps, and they haven't fallen, I mean relative to the market, whereas the giants are following, you do not have a situation where the leaders collapse or are correcting, and these smaller companies who are otherwise not, they don't have a sustainable sort of history, and all of a sudden they're wanting to dilute capital. There's something wrong. So if you as an example happen to own a company that where the longevity is at doubt, this is a good time to use your currency to get into much more stable managements, which have leaders who know what volatility is. They will know what to do with Russia. As an example, suppose a company, I'm just again giving an example, again it's not a recommendation. Suppose a pharma company's exposure to Russia is 2%. It's much more easier for that pharma company to tackle 2% than a company who says, 55% of my sale is to the CSIR region. So you have to, at that point of time, say that if the CSR company, for example, a company with 50% exposure to CSR falls 50%, then what are you going to do anyways? You've already sort of knocked off, because then after some point of time, you're not going to expect that there's going to be no trade with Russia for the rest of your life. So it's a very objective call, a very subjective call that you have to take, but you have to keep objectivity in your mind. So at the end of it, if you have in I do not know what returns people have made, but I'm assuming that in the last 2 years they would have made at least more than triple digit returns, and out of that they would have knocked off maybe another, maybe I do not know, maybe 20% of their gains, which is fine. uh, don't forget from where you were, where you've got, and don't forget where you are. You're going to be measured from today. So if you find value today, the value is going to give yields tomorrow or day after, or a few months line. Don't go by looking at the past prices. I mean, for example, some of my own stocks, and I'm talking about my own portfolio, some of my own stocks maybe in the last few months were at very exaggerated prices. I may have enjoyed it, but did I believe that I was going to buy them at that price? No. Why did I not sell? Because I'm not sure at what level of growth they're going to come in, so I'll have to give it a sort of a balance effect. And to that extent, you don't. And it's a very interesting thing, and this is very important from my perspective to clarify to you. Every time I'm accused that when I come to interviews, particularly on television, or I come to chats, which is a new phenomenon, they say, but you're always bullish. But have you noticed that I was not bullish for the last few days? Which is not to say that I was selling my portfolio. I said, the reason why I said I'm not bullish is because I said I'm uncertain with what is happening around the world. I am confused between what the Fed is doing in terms of tightening. Confused with inflation, and while RBI is doing a phenomenally good job, that is not necessarily true about monetary banks outside India. I'm confused about the fact that the retail has seen the market do very well for 2 years and therefore has religiously pumped in money. But I do not know whether they will be able to do that when the market sees downtrend. For example, this fall that has happened, will they behave in a sane way and go to all the good funds and the PMS managers and continue to deploy money, or will they get so psyched out by this the fall that they'll come and say, now all suddenly equity has become a bad word and we're not going to give you money? What will the fund managers do? The fund managers find it interesting to buy stocks when you don't give them money. And when they find that the market is becoming overvalued, you keep pumping money, and then they have to deploy it because they don't know what to do with the money sort of gushing in. So the behavior of people is not something that I know of. So I said I will take a pause, and therefore, contrary to what I normally tweet, I've not been saying that in the last few days that I've been deploying fresh money, but it appears to me from the market, the way it is positioned and the way it is, some of the good companies have corrected, that it may be time to start nibbling a little bit back onto some of these names. Now I'll pause here and let other people participate.
Safir, before we sort of welcome in other people to ask questions, I just wanted to ask you two questions for the audience to understand this concept better, because what you've pointed out is actually of a lot of importance, which is around the margins essentially. When you spoke about companies that have had raw material pressures and have other kinds of pricing pressures going on, their margins have been artificially depressed. And there are certain companies that you spoke about that have got, their margins have been elevated, or they've been pushed even slightly beyond peak because of the additional operational efficiencies that have come from COVID. So for somebody who's relatively newer in the market, how do they get a sense of where the company that they are looking at is in terms of margins, besides just observing historical margins?
Yeah, so it's as an example, there are many ways. So one of the ways, I was I was having this discussion last night, and some people said, but steel will be in a continuous uptrend, or for example, non-ferrous or aluminum will be a continuous uptrend. My point is, if the raw material prices, and similarly, what is happening with fuel currently, what is happening with power cost, etc. If the raw material prices continue to remain high, basic economics tells you that the viability of many people to do business will be impaired. It's not as if and in a very simple word, it's not as if I go to the market and the cost of food keeps going up, I will continue to sort of consume that food. Then people start looking at alternatives. Some people will, as an example, if my earning power is impacted for whatever reasons, when COVID hit and the world had lockdown, you were not at that point of time gallivanting and seeing that no, next, no matter what, I'm going to have the most expensive food in town just because of anything else. It's only when some level of certainty sets in and you feel that no, the survival instincts are not being threatened, then you will come and say, okay, I can afford a little bit of indulgence. Similarly, businesses, when they find that this going on the raw material side is something which is of a temporary phenomenon, only then they will do capacity expansions, because then they will find that the future profitability will be better. Then you again go back to economics, then that economies of scale set in, because then if you find that the capacity is going to increase, you will be able to bring in a lot of efficiencies by production in other forms, and you'll also try to minimize your wastages around distribution, logistics. Sometimes you will find alternate resources because if something is not so, there is always a self adjustment mechanism that happens in the market, in at least on the production side or on the part of the companies. There is always a level of innovation that people do. Don't forget, for example, see, when we look at banking, look at the amount of innovation that is happening on the technology side of banking. The technology side of banking is reducing the cost of transaction for the banks. Today, the cost of acquisition of clients is impacted. Just before that, you've had a time when the banks had adapted to ATMs, which became a complete transformation. Just before that, you had a concept of CASA, and everything became current account and saving account. So the transformation of is real, and it happens across companies. Also, if the world is truly to move into e-vehicles, now whether that happens in 2025, 2030, XYZ, if the world is truly to get into newer forms of transportation, newer forms of logistics, newer forms of sustainable foods, biodegradable products, etc., then each one of these is a transformation. Similarly, in the IT industry, if there's going to be a transformation into cloud, which according to me is a colossal opportunity, that somebody is going to be enriched by the system. Now, when somebody in an economy is enriched by a system, he's an end. He's a means to several other people, because it is a sort of a rub-off effect. For example, he may pay more salaries. The people that work in those companies, because they get more salaries, turn consumers. Whether they buy housing or they buy, have wealth management services or XYZ, it's all sort of a link up. So therefore, to believe that it's going to be a one-way traffic where the metals will do well and the whole world, other industries will not do well, is a wrongful belief. The second side is, if the metal price is correct, then some of these companies will find that the raw material prices have sort of reduced, and they will somewhat be able to pass it on to people because they want to really bring in volume growth. That itself means that either ways, you cannot be betting by saying that no, metal prices will go up and the rest of the industries will suffer, or that the metal prices will correct and so much significantly, and therefore we will not need to buy these things in order to make our ports, dams, airports, roads, defense, and so many other things. So it's just the logic of doing this, and therefore you should, because it requires a balance, you should not tilt too much towards one side, and defy certain other companies that have historically shown you how they create wealth. So somebody, for example, if I was an entrepreneur of a company and I otherwise had a very credible board and I had very good advisors, if I find that the problems today are on the logistics side, I will reinvent the logistics side. If I find that the problems are on the material side, I will reinvent, including by sustainable or recyclable material. If I find that the problems are lying on the consumption side, then I will innovate, either in terms of funding or reducing the cost of capital, or coming out with some sort of incentives in order to galvanize or to sort of augment the thing. So, because those managements have been able to do it over a period of time, today you are actually getting a discount on their ability to do that action. And that discount is only something that's happened in 2 months. I can understand if there was a continuous disruption of their business models and you say the decline has happened over 5 years because they're getting destroyed. But in reality, some of this correction has just happened because a class of people looked at quarterly results which were flashing, for example, on television, newspapers, or on social media, etc. And they said, you know what, operating profit margin is 18 versus market expectation of 20. But the market expectation of 20, if it had come in, the stock would have not corrected, no. And now it's not as if this is going to be a continuous deterioration. Because if it is, then that management is not competent. They shouldn't have been in the leadership position. After all, many of these people are leading their respective sectors. So that is a clear opportunity, according to me. And that is why the market over a period of time reverts to mean. Because a lot of these inefficiencies will move towards efficiencies. A lot of efficiencies will start moving into stagnation. Some of the efficiencies will move into inefficiencies.
Fantastic point, Safir. Guys, please take advantage of all of this insight that's coming out here today. Listen to the recording later on. Look at these three categories. Look at your own portfolios. Reflect on it, and then only will you be able to truly benefit from the kind of wisdom that's being dropped here. Karan, you had a question or something to share?
So I think I was just listening to the question and what Safir had to say. So, looking at historical margins and what has happened in the last 2 years, see, there are multiple factors at play here. One is businesses of a certain size, and I'm not talking about listed companies, but say the SME sector, they were fairly large participants in many categories in the market. Because of capitalization issues, headwinds, because of frequent lockdowns, and everything else, a lot of this business has also, steadily been creeping up into the formalized sector. So a lot of the expansion in business that is occurring is actually a shift in market share from this large amorphous mass of companies to the large listed players in each segment. Now that that shift has taken place, and let's assume more than half of it is going to stay with these companies, now you'll get to see that, okay, if 3 or 4 companies in a certain sector have already gained, from here we will start seeing the next stage where the ones that are really good at executing and executing at scale, they will start showing a marked difference over a period of time. Secondly, whatever is occurring in the last 30 to 50 to 60 days since this year has started, it's a remarkably different narrative, and the market is reacting to the narrative. And certain stocks which were overheated because of the narrative before 31st of December, they are now basically just reacting to the change in the narrative itself. The underlying performance we will only get to see, most quarterly results are done now. So when April comes, that is when we really start seeing who is doing what and what is it changing. So unless there are a set of companies that were exporting something to Russia or importing something from there, and the underlying commodity prices for those products go in a certain way, it is not realistic for us to look at each individual stock and say 90% of the market declining today means 90% of the market was overvalued. And those of us who are buying, we are simply not in this game today to buy because it has corrected X percentage, but because we believe that there is a gap between what the intrinsic value of the business is and what the market values it at today. And I think that is the you know lens through which we should look at what are these moats that are developed. Are they durable enough, and do we see them continuing the next year, the year after that? This month we will look back at it like people who've been in the market for long look at all the other things that have happened, uh, which have been defined as the market went down by X, Y, and Z.
Yeah, one point that I wanted to add to what Karan just said, and I totally agree with his thought process, is that as a practitioner whose job is only to help companies create moats. That is my profession itself. Being in intellectual property enables companies to create moats. Let me tell you one of the moats that nobody talks about, even the study, and I had in fact at one point of time written to Mr. Ramdev Agarwal also saying that after so much of work that you've done on wealth creation studies, which is fantastic, one moat that nobody talks about is the resilience of a company to adapt to change. That itself is a very big catalyst, because every moat is not an identified moat that exists in front of you. Certain, look at anybody. If you look at a business model, look at, for example, the broking houses today. If the broking houses have been able to adapt to a model where they're taking on somebody who's giving a zero brokerage, and yet they're able to transform because of either the digital onset or because of the varied level of services that they have done, or because of the way they're managing money, or the way they're managing risk, that itself is an evolution and process. Now, if you start looking at certain companies' ability to withstand a lot of the winds when they arrive, and are able to adapt, what Darwin called as the actual survival of the fittest. He said you don't have to be the strongest, you have to be the one who adapts the most. That adaptability itself gives a lot of opportunities. And when you read about companies adapting in that process because of the onset of several factors like the ones I'm talking, and at the same time the market is at a situation where it is not able to appreciate initially the efforts that are going into that adaptation, it is usually a sign that over a period of time you have a very good chance of doing well in those companies.
Absolutely, Safir. I think it's super important to figure out um, these uh, these modes that exist in hidden spaces, and dealing with adversity is absolutely, one of the competitive advantages that doesn't get spoken about. Another one that, for me personally, works, or has been a source of tremendous gain, has been the speed and efficiency at which the company works. The company might have, a similar business model than what the guy next to him has, but if he has figured out a way to execute faster, and like, how Asian Paints had been able to do with their logistics model, the moat might not even be uh, in the product itself, but maybe in the delivery of the product, or in the production of the product, or in the sourcing of the product, or in the supply chain. And I think these sort of modes tend to get ignored far more often than the more visible modes, like the ones that are spoken about with something like a Nestle, which is a regulatory mode, which is much more visible for people to see and figure out. And yeah, it's really really important to look for more intangible and more invisible modes in order to be able to refine one's investing practice. With that, let me welcome Manish. Manish, do you have something you want to say, or you have a question for Safir?
Yeah, I have one question. To be just very optimistic, is there any industry in India which is likely to benefit by reduction in imports from Ukraine or Russia? And similarly, is there any industry which will benefit from rise in the crude oil price because their product might become cheaper comparative to the international prices?
See, sir, I don't have a necessarily on the point answer to your question because it is a very recent situation, and I've not gone into the dichotomy of that situation on a industry to industry wide basis. But the one point I want to make, which is a point, for example, that I would deliberate in my own mind is, on one side, we're talking about, or at least the auto majors are talking about a move towards e-vehicles. When I speak to some of the companies that are in the business of e-vehicles, I find that the overall offtake, particularly there is a greater level of disruption that is happening on the e-vehicle space when it comes to two-wheelers right now as opposed to four-wheelers, because obviously they become logistic instruments of logistics and therefore deliveries and other things. Two-wheelers, three-wheelers are adapting to a faster extent right now. Electric cycles are adapting to a faster extent. On one side, we're talking about the elimination of or the reduction of oil. On the second side, therefore, by adapting either to a EV model or a hybrid model. On the second side, companies as big as Maruti are talking about a CNG model. And this phenomenon is not only a phenomenon in India, it is happening all over the world. So, right now, to take a call which is basically just because of a temporary, I at least think, a temporary rise in crude. It's not, basic economics told you the difference between demand and supply and what price movements do cause. And right now, when there's an industrial migration that is happening, to basically take a call that how the rise in crude would benefit somebody or impair somebody isn't a slightly difficult call. And in between this, you can throw in green energy and you can throw in the environmental sustainability theme and many other things, and it becomes even more complex. Now, look at the other side of it also, which is like I'm just playing the devil's advocate. If there are sanctions that are imposed on Russia, which US has said that they are going to impose sanctions, in reality, how much of the sanction has been imposed between US and China? Let's first evaluate that. Because the moment US says that I'm only going back in time, and you know what happened when COVID hit and China problems were coming on many, every day US and China were having a battle, and they will say, we'll not allow your companies, we'll delist from US, they will not allow XYZ, etc. Now China has started fighting its own companies. Look what they're doing to Alibaba and what they did to the edtech sector, etc., etc. So it is too complex a variable to think like this, because if America, as an example, imposes sanctions on Russia and Russia comes to India and says, I want to become a buyer of your services, then overnight the dynamics of our companies can be changed. Similarly, for example, just 1 or 2 days before, that is before this, India gave a warning and asked its people to move from Ukraine. India actually had announced higher number of flights. Air India had announced higher number of flights to Ukraine, which was also sort of not making sense at this point of time. What were they attempting to do? Were they talking about evacuation, or were they talking about an opportunity or something? Now, historically, businesses tell you that when there's adversity, somebody is going to knock the opportunity and sort of capture it. So it's very difficult for me, at least as an individual, to take a call on whether this will benefit, whether somebody will become, because Russia can create demand for anybody. And one of the biggest problems of investing in companies, for example, in the rice sector, which where I've repeatedly looked at companies, is that every now and then Iran will do something and we'll say, oh, now it's impacted. Then the Middle East will stop buying because something has gone wrong with the infrastructure development there. It is very, very complex to sort of have a precise answer. And even if it is there, it will be a very short-term move, which will not even last more than a quarter of that company's earning, because it cannot be that Russia will remain in darkness and the world will accept that and will live on with it. They will also do their own stuff. So I at least don't have the competence to answer that question beyond the explanation that I've given.
Thanks, Safir. I think that's more of an understanding than anyone can kind of hope for in this moment. And it's also very important to pay attention to what you pointed out, which is the fact that allocation based on temporary gyrations in the market doesn't make a lot of sense when it comes to the long term. Um, we also have Dr. Tanmay here, who also hosts a bunch of investing rooms. So, hi, Dr. Tanmay. Do you have something you want to share about the current market situation, or do you have a question for Safir, sir? I guess he's unable to speak right now. Uh, anyway, Safir, when we look at these three different sections of the portfolio that you spoke about, defensives, the players that have been hammered, and the third kind, uh, how would you look at allocation between these three? You know, between these three groups of companies.
Yes, so see, the allocation is a flexible rubber band. When I say it's a flexible rubber band, it depends upon, somebody has the appetite for growth, somebody has the appetite for risk, somebody cannot see volatility, somebody will come and say, for example, today if the market was down, say on the mid, at least on the mid cap and the small caps by about 2%, but a lot of people on the large caps would have not seen similar erosions in the portfolios because the large cap index was relatively very stable. So the question is, still what has happened today is not going to decide your returns tomorrow. Just as an example, and I'm just trying to explain to you, I have to be tomorrow on ET now at 9 o'clock in the morning, 9:50 in the morning. The morning situation may be very different from what we are talking about, vis-a-vis all these geopolitical factors and how the markets react and all that, to take a call. So let's assume in the morning, for some reason, the mid cap index is up 1.5%. Now, all of a sudden, will I feel victorious? Because in effect, human beings react like that. In the morning, if we find that our portfolios are up 1.5%, at least on the mid cap and small cap side, we will always start believing that the recovery has set in. It's always happened like this. And when the market, and that is why in the morning, if you saw the market down 1,200 points and it recovered to even 300 points on the BSE, irrespective of whether your portfolio recovered or not, you would feel that no, you're relatively coming out of a pain. That's how human psychology is. So, how you're going to position your portfolio, the reason why, your first important thing is to understand, why are you doing this? You're doing this because you want to tide over uncertainty. It is only when you are, it's like this, only if you live longer, then you are able to compound more, no? So typically, if your portfolio lives longer and it doesn't get rogered in this market falls, then you have the ability to sort of do more adventurous things and more daring things when the market comes your way. So that is the reason why you are reclassifying it. So I don't want a situation like, for example, when I did this survey on Twitter a few days back, a lot of people, that time 37%, but now I believe the number will be even higher, had already said that their portfolio had been eroded more than 20%. Today, that 20 could have become 30%. Now, that's a lot of capital gone if your capital base was small, or for example it was the source of a lot of things that you desire to do in life, it is, and also mathematically you know how difficult it is to recoup that 30%, because unfortunately the fall of 30% doesn't mean that the recoup of 30% is going to, you know, do justice to you. So that is why you're positioning your portfolio in a situation where you do not understand Putin, you do not understand Biden, you do not know what is happening. I do not know what is going to be the outcome of UP elections vis-a-vis the market. I do not know what LIC IPO will do because of the impact that has happened in the market. Will it sail through? See, don't forget, success for the government could be the LIC IPO sailing through. But for an investor, he wants to see how much money he makes, because that's why he's investing in an IPO. Similarly, for example, somebody says I had surplus money as an institution and I have deployed it, for example, in LIC, and therefore I have no other money to buy the market. Itself is another sort of impediment. So that is why you're positioning your portfolio, because there are too many variables. You still don't know what the Fed is doing. While people keep talking about interest rates, they actually ignore the fact that the interest rate hike has usually goes with the increase in the market rather than the fall in the market. But the most smart people, despite having the facts of this from all the historical evidence, are still coming and debating every single day how many interest hikes will be. I mean, why are you even discussing whether there'll be 8 or 9? First, start with one, see the second, see where the world growth is, see how stable the world is. But we're just jumping to so many conclusions because there are variables, because people can be irrational. For example, today itself, there are certain stocks that may have fallen 6 to 7 or 8 to 9% in today's market that had nothing to do with Russia. So all of a sudden, why were they falling today? Because somebody has incurred a loss somewhere else and he's trying to knock off his portfolio, or maybe there's a lack of buyers, or maybe the institutions are focusing on some other thing, etc., etc. That is why you are creating a sort of a widespread portfolio. You're creating it in order to ensure that when the market does well, you reap the benefit of the uprise. And if the market was to stagnate, you will be able to get some amount slightly more than the market. And if the market was to crack, you would not go down 25 or 30% like some people have gone down. What if all your portfolio was in new tech companies, as an example? Would you'll be sitting with 60% losses today? And mind you, some of these new tech companies, even after their listing, when the prices had not corrected to this extent, were being touted as very disruptive and very innovative and very fast growing. But that's not played out that way, because it is inevitable that this happens repeatedly. And you know, do you realize that in this market correction, I am just giving an example. Why is real estate stocks fallen so badly? Is it like once after one day? You just last week read XYZ builder has launched so many apartments in Bombay and they got sold within 48 hours, and so get launched this and it's sold. But then all of a sudden have tumbled because somebody's losses will sponsor something else. So you have to be prepared, because you cannot control the, what they call it, you cannot control the irrationality of crowds. You can only control the fact that you have to do survive, then have the ability to thrive when the market gives you an opportunity.
Absolutely. I think there's a lot of insight there that's come from a lot of experience. And when we look at things, step by step and see how they evolve, we develop the ability to respond to a constantly changing environment, which is what the market really is. Dr. Tanmay, are you able to speak now?
Yeah, I think I'm audible now.
Yeah.
Yeah, I got scared. I thought you were preparing anesthesia to give me.
No. So I do have 2 cases at night. Wait karat, and I just joined in to listen to you. It's always a delight, listening to you. And thanks, Krishna, for having me over. So you want me to add on the current scenario or what?
Yeah, current scenario, or if you have a question for Safir.
I think we did discuss, we had a really good space, I think, a few days back with Safir. So I don't have questions. Maybe I just say कि मतलब अगर माइक्रोस्कोप से देखोगे ना आप मार्केट को, तो बहुत ज्यादा मूवमेंट्स लगते हैं, बहुत सारे रीजंस मिलने वाले हैं. A few days back the narrative was that coal khatam hone wala hai. That was the panic situation. Then interest rates की बात चल रही थी जहाँ पे people were saying that the Fed may increase the interest rates, the liquidity may vanish out, and different kinds of narratives. Then this Russia Ukraine has come up, so different sort of narratives will keep coming in. But then I think for a retail investor, the person who is who is actually owning a bunch of stocks, he actually needs to worry if their quarter on quarter earnings are getting affected, or there is some actual change in the fundamentals of the company that we are holding. Otherwise, why need to look at the market every single day and panic कि यार price 5% नीचे हो गया या 10% नीचे हो गया. Although if some stock that you have been like holding for a long time and you are like couldn't find the opportunity to add in the numbers that you wanted, or your allocations goal is not yet met, then probably it is rather an opportunity to buy on such kind of stocks and just keep adding those at a fair kind of valuations. Often there are lots and lots of stocks who that will never come to the fair value or something like that. They'll always trade at premium, but in such kind of panic wherein the people who take out the money will, there is a very famous saying where it says that during the time of crash, the stock returns to its original owner who is there. So I think the one who is patient enough, the one who has been following the company for a long time, whichever company you are owning, and if you believe that the earnings, you see earnings growth visibility that is there, free cash is gonna go, then I don't think such kind of incidences should worry us a lot. Safir had put up a tweet today, and I did also comment on that. He was saying how he takes confidence from the calls that he has taken previously in such kind of incidences, and that gives him the confidence to go on. Even I also started doing this habit a few years back, wherein I used to write, if I wanted to buy a stock, then why would I want it, what are the valuations that suited to buy that stock at that particular time, or if I'm selling some, then why am I selling it. I used to maintain a diary of that, and every now and then, a year later or 2 years later or 3 years later, I look at that finance diary which I maintain, and therein I see if the growth prospect was there at that time, the story which I believed in, and then purchase that stock at that time, if it is still there, then why to worry it at all. And if the stock price, if the decision that you had taken at that time has given you really good returns, then you do gain a good amount of confidence from it. And another thing that I also do is, even if I don't take a buy or a sell call or something, even if I skip a stock, okay, if there was some reason why I didn't buy a stock at particular valuation, or because of the fundamentals that I did not like, then probably I would skip it and I would write it there, and I will see a stock in 2 year or 3 years time, and then probably I would still learn from it. So I would take it more as a learning thing. The more time we spend in, the more analysis we do, we keep on growing over a period of time. And always it's a pleasure listening to the veterans who are there, who have been there in the market for a long time, to learn from their experiences as well. So we need not do the set of mistakes that they have done, or if they are sharing it out loud in the public, then we can just listen to them and keep on tracking that if we are not doing the same set of mistakes that are there. And the guidance also really helps a lot. So I don't believe ki when COVID came in, everyone was saying that probably the world will end, uh, human race won't be able to combat this, and look at us now. We are lots of people are going out there in the public without mask also. They are not fearing anything. COVID has become like, we recently encountered the third wave, which was mild, and people did combat that as well. And now we are confident that okay, we are probably out of COVID crisis, which was once seen as a situation of doom, wherein everything would fail and the markets crash like anything. So I think mankind is really powerful. There are different set of challenges that have come in. The narratives keep on changing, markets crash hote rahenge upar niche, but then eventually we will overcome those kind of struggles that are there. And if we have a long term perspective, then I don't think there is a reason to worry much about it. Over to you, Krishna.
Thanks, Anmay. Before I comment and take this conversation forward, I just want to also let Vivek ask his question because he's been waiting for a while, and then I'll chime in after Vivek. Vivek, are you ready to speak?
Yes, thank you. Yeah, I was just trying to unmute myself. Firstly, it is quite astonishing that We have a forum on a day when there is a big tumble in the market, and from the voice, obviously we are also picking up cues as you speak, right? The amount of confidence that is flowing from Safir ji is quite what do you call it? Is quite refreshing, because those who are in the market know what the pain is for the participants. So my question to Safir is, to the extent that you're comfortable, can you speak about how your own portfolio, I mean, you don't have to probably even name names, but how has your portfolio kind of reacted to, this unfolding almost chaos and catastrophe? Because, he's got a parliament not to take military action, and the US already considers this as an invasion. So I'm sure Putin will follow through, and there'll be a big reaction in the market, because every country almost would be affected. So if you can speak about how your investment philosophies, the whole idea is for us to pick some ideas and refine ourselves, because some of us are suffering, right? And so we want to get better at this. How has your portfolio withstood it? And and what is the thought process behind building the portfolio, which also has to face these kinds of situations? Thank you.
See, while you are talking in context of what you are calling as an inevitable Russian invasion and the implications of all that, let's not lose sight of the fact that the world markets, that is not to do with India, but the world markets which are way more advanced and which also have very sizable players, are already right now open and running. So what is the rationale of, for example, a FTSE being in the green right now, with the news that is already flowing from Russia, as if they are not tuned in? What is the rationale of now? If you look at Dow and say it is down 200 or 250 odd points when I last saw it, don't forget that Dow was shut on Monday. Dow is reacting to 2 days by falling not even 1%. So, or whatever X%, and Nasdaq, and which has been very volatile, and where the companies derive businesses a lot from Europe, and therefore would be impacted by any disturbance in Europe, is behaving in a very rational, normal way right now, as if it was a normal market day. This correction that the US is seeing right now, or the green that some parts of Europe are seeing, is a very rational move. So why is it that all of a sudden this is going to be an inevitable result only on India to begin with? Because more advanced brains with billions and billions of dollars and very large impact on the market when we're buying and selling and really mess up the market moves, are not reacting in the same way right now. First point. Second point is that Russia is also, don't I'm not a political expert, and I'm not good at, I don't want to talk about things that I'm not good at, but according to me, I do understand negotiations, because as a lawyer and as a successful lawyer, I know what negotiations are about. Russia has even now told Ukraine, look, my troops have entered, I'm giving you last opportunity. And Ukraine has replied back saying, we're not scared. Just see the commentary just a few minutes back. Why are you even making, I mean, do two people fight in this way, that one comes into your house and says, look, I've come into your house, now I'm going to kill you. The second guy goes and stands in front of him and says, no, look, I'm standing in front of you, I want to see how you kill. Then they're still talking. That is the essence of, that is how it is happening. And then America and Germany and others are saying, look, we are going to impose sanctions on you. Then Germany is saying, I will not announce the sanctions right now, because I don't want you to be prepared. So I will announce the sanctions after some days. And America is telling them, look, we're going to do this right now. And then I'm not going to meet you. Biden is telling him, now I'm not going to meet you. See, these developments are, it's like there are pressures that are trying to be imposed, because inevitably either side, whether it is US or it is Russia or it is Ukraine or it is UK or it is France or it is Germany, either side, everybody is trying to measure where the solution will come from. I don't think, I mean, at the end of the day, suppose for whatever reason, let's go to an extreme that there is a war and that war becomes really bloody, messy, economically destroying, etc. What are you going to do with your portfolio? You should be then bothered about your business first. You should be bothered about law and order situation in the world. You should be bothered about whether it becomes a world war, XYZ. Then it's not. But this has not happened. In today's world, the economic interest is so high, interstate so many countries, that it has not happened. We are not talking about the past. Even today, people condemn, right from Pearl Harbor to Hiroshima, etc., is all condemned in history.
So, Safir,
So
see,
it's not.
I like the way you've logically dissected it. But as investors, we need to have a sense, and where I'm coming from is really the aspect of margin of safety. What are we doing with our portfolios? And that's what I want to glean from you, is what are we doing with our portfolios that will help us ride through even these kinds of storms? So if you can help with those inputs on how a portfolio construction can happen, even taking into account doomsday scenarios.
Actually, see, the concept of margin of safety, according to me, is a very misnomer. The margin of safety is higher today than it was a few days back, because in an inevitable correction that the market has done, it takes out excesses, it takes out exuberance, it starts taking out, for example, wherever there were pockets of madness. It will take out a lot of premiums from the IPOs. It will take out a lot of crazy valuations that are happening on the private equity side. I meet private equity companies. They come and tell me to put money. I say, what is your valuation? They say 10 crores. They meet me after 3 months. They say 50 crores. I said, which order did you get? They said nothing, which is round two. As if round one to round two, you went to school, you went to class one, you went to class two. In class two, you said, because I've reached class two, today I should be qualified to class 10. Just because I came first in my class, or I came in whatever XYZ reason. So there's an irrationality in the market. That irrational. Now see, why is the world market? Why are the metals not collapsing in a situation which is believed to be so catastrophic in the world right now? Why are the metals not collapsing? Why is the oil not collapsing if the world is going to shut off some part of the economy? So right now they're just it's an equilibrium that is happening. That equilibrium is being characterized by extreme volatility. Volatility is a friend of the investor. The risk profile is improved, because I'll tell you something, and I'm being very candid with you. In January, if I was sitting and I was making, in January I had some surplus funds also, because I'd done some amount of selling also in the market in December. I couldn't identify stocks to buy. I was forcing myself. It was literally like I was holding a magnifying glass and forcing myself. Today, without anything, if I right now switch on, suppose I open the Bhav copy, I go to NSE, BSE, or download the Bhav copy. Why will I download the Bhav copy? Because it's not as if I've got a fixated mind that I have to only buy XYZ. That is one way of investing. But I see the Bhav copy and I look at certain scripts and say, "Arey, how is it possible that this guy has fallen so much? He's not at all worth this fall. He deserves more." And the question that I'm going to tell myself is that I have money, for example, in my bank. That money in my bank as of 31st December 2022 will probably earn me 4.5% interest. If I have to beat that 4.5% interest, and I find that my stock can give me a 15 to 20% return, I will do 4 times or 3.5 times better than what the bank will give me. Today, when I look at the screen, today means after the market is closed, there are a lot of stocks that I feel that I will be able to make this 15 to 20% return. In between, they may fall another 10%, and I'm saying a 15 to 20% return from the current prices. If they fall 10% more, and if I have the ability to buy them more, I'll probably make better returns. Similarly, I look at my portfolio, and if I find that there are pockets of exuberance where I, uh, as somebody who should have been more rational and should have been more practical, have not been able to in cash because I got carried away, then I will adjust to some extent. Similarly, for example, if I have a company that is expected to grow at, say, 10 to 12% per annum. I'm not talking about a stock price growth. I'm talking about business growth. Whereas I find that a bigger leader of a higher magnitude, or with a better financial acumen or better market acumen, is also corrected to the same extent, then I would switch the currency. I will say I will rather hold a more stable and growth-oriented stock than something which is going to be more volatile.
This is very helpful, Safir. One final concluding point is what number of stocks typically on average you hold in your portfolio, And
So this question everybody asks me, but I'll tell you the reason why
because you
we
are quickly able to go to cash, that is why I'm asking this question. Because
I
you
don't
churn
go.
and go to cash.
No, I don't go to cash.
You don't go to cash.
No, I don't go to cash because if I find that the going is wrong with the company, which can happen, going can be wrong for multiple reasons. One is that you made a bad choice about a stock. For example, you ended up buying, say, Yes Bank, and you made a bad choice because things have gone wrong. Or you bought a company and certain governance issues have crept in the company, and that is sort of worrying you. Or you have bought a company and the company has not done a governance issue, but the management is very confused and is trying to work too hard and is diversifying unnecessarily into product lines that may not be good allocation of capital. Then you will revisit those. Like, for example, why did I exit the insurance companies and I made it public? Because it was not, firstly, the insurance company was overvalued, commensurate to growth. Secondly, when I went and asked people during the COVID time, they said, no, we're not going to be taking insurance. So I said, why are you not going to take insurance? They had a very different logic. They said, we have lost 2 years of our life by being home, by being confined, by being denied travel, by being denied the ability to meet friends, watch movies, etc., etc. So our priorities in life for the loss of 2 years, considering that human life is limited, have changed. Then people said that I had insurance, but I made a claim, but they said it's not covered under COVID. So our foundations about the faith of the insurance company has been impacted. Then some of the insurance companies said that wherever we were forced to give, force means whatever by our contract we were required to give insurance claims, we have therefore suffered this, and now we are increasing the insurance premium. So they did not realize that in some cases there was a contraction of the demand because of earning, or because of uncertainty, or because of job layoff, or because of any level of disruption. Now, don't forget, if somebody is is an entrepreneur or a sort of self-employed person, he doesn't have the same luxury that he will get his salary because somebody else has gone to office and working now. So they were self-adjustment mechanism. Now what has happened is that when you looked at that and you looked at another onset of an LIC, which was at that point also inevitable, you knew that a big daddy of an IPO in the sector is coming. And you know the fact that by historical reasons, the government divestment always happens at a sort of a discount. Even now, LIC has announced that you will get a discount if you're an LIC policy holder. So when you come and say a large player in the industry's price to earning, or large player's enterprise value is going to go at discount, why should the others be at a premium right now? So you have just applied your logic to it. And as a consequence, when I had written and I had exited, as an example, ICICI Lombard, somebody had validly from his point of time come and told me, but you have exited, but you don't know what is going to happen. This 1 year is bad, but next year will be XYZ. The stock is way below my selling level. The money that you got from that has been utilized to buy something more efficient, which is what I call as a currency swap vis-a-vis scripts. And if you, instead of losing 20%, you probably made 40%. So in a sense, you have bettered your portfolio. Now, if out of that return, say 4% has been lost because something has happened last week or something else, is it disturbing my equilibrium to realign the portfolio? No, it isn't.
Thank you very much.
So just a quick announcement before we move on, guys. If you are new to the space, please DM me your questions. We use this mechanism to filter out any trolls, and keep the conversation focused. Next, we have Nilesh Shetty. Nilesh, you can unmute and ask your question to Safir. Nilesh, you're on mute.
Yeah, Krishna, thanks. Thank you for the opportunity. So, Safir sir, basically, I have been reading on this thesis that due to the rising inflation, this FMCG companies, the consumer staples, will face margin pressure and they'll underperform going ahead. So, just wanted to know how far this thesis is correct. I mean, has there any cases previously where due to this rising inflation, these companies had faced pressures?
Well, of course, rising inflation currently seems to be a bigger worry for FMCG, but the worry from FMCG is coming from many counts. One, it is coming from the raw material point which you are articulating, but there is also a lot of migration happening in the business models. For example, many of them are having to adapt to digital. Many of them are changing their way they advertise. They used to have traditionally a very good reach because of advertising, which is getting away because right now nobody wants to read newspapers and the hoardings are not there. Then it's getting impacted by the lack of travel, because when people travel, they develop a particular zone, then a new market develops. It is happening by a lot of good quality startups that are coming, and because of new businesses or models like Amazon, Flipkart, etc., that are making a lot of these products available. For example, if you go to some of these blogs or some of these, like for example, you go to Instagram. Instagram is not promoting the products of these companies that you're talking about, but you will find that a lot of new varieties of noodles, pasta, this XYZ products, face creams, acne lotion, so many products are coming and they are getting endorsements of end users because of the way the business structure is being done. So what is going to happen is that there is one side of the market where the large companies will be able to innovate, and you will see why Unilever or companies of that sort have, like for example, even a Colgate, now they've come out with an oil pulling, it's called, I think, some product which is to do with oil pulling. It's the Vedic concept of putting oil in your mouth and gargling over a certain period of time, which is very good for, it is an antibacterial sort of a thing. So when they will evolve like this, Colgate as an example, and I'm again not recommending it, Colgate right now has more than 200 300 products that it hasn't even launched in India. So when these companies innovate, with Unilever has innovated, look where they started off with say for example where Dove was, and now Dove has become a shampoo from a soap, and how for example they have moved, if you go into history and you see what some of their peer soaps used to be and what they are today, what they have done to Lux, and how they've got into from a basic soap into a shower gel, and now to a shower cream, to a moisturizer, etc. They have evolved. So when they evolve, they're also able to move up the price points. Like Britannia at one point of time was moving from basically like a tiger biscuit into cream based, then into cakes. But when you, and then into croissants. But when you find that the market is not receptive, because the market gets a better choice for any reason, I'm just not saying that in any, then you will have to re-examine and say that maybe these companies, because see, one of the problems with being a very good company, and some of the consumer companies are fantastic companies are not necessarily the best investments, is that they have squeezed both the top line and bottom line. That means they've removed all the inefficiencies into the system, so they do not have any bottom line growth. Now they only need to have top line growth, and they're already sitting with a very colossal market. So, for example, if a company is sitting with say 52% market, it has to fight its own self. It has to fight its own products, which is way more difficult than somebody who's creating a market segment. And anybody who's created a market segment, if you go back in history and say, okay, somebody came out with a sachet shampoo and they created a market segment. Somebody said, okay, I'll take up coconut oil and I'll create a market segment. Those market segments then create a lot of, or for example, fairness creams, or so many examples that you will find. Today, that level of innovation is coming from too many quarters. So I don't personally feel, and the consumer companies, sorry to say, but are at an extreme premium. They look at the amount of premium that some of the Indian subsidiaries of these companies have vis-a-vis their own parents, whereas the parent is going to bet on the growth coming from India only. So if the growth comes from India and it goes back to the parent is available at ridiculously low valuations in comparison to what the Indian company is generating. The Indian company's valuation should have been premium if the growth was premium. Or if, for example, if the company is at a 25 to 30p, then you'd say, yes, historically also it's fine because they're very good allocators of capital. Now, also see one very interesting thing. The consumer companies, because they are such excellent allocators of capital, are not able to put the capital to use, because they do not find that if they put the capital to use, I mean, for example, if the market is not receptive or the product is not receptive with needs, so what are they doing? They dole it back and give it to you, because if they keep that money, the money will not give them adequate returns. So the cost of capital, the capital employed will fall. That's why they dole out dividends, and they'll say what, 250%, 300, 400, 600, 700. Now even some of the pharma giants are doing that. If you look at it, for example, look at the kind of dividend that Sanofi has announced in the last 3-4 years, because maybe they can't put the money to use. But that money is also finished now. It's getting distributed. Either the cash flows are intact. Now, if I, as an example, I keep reading about the comments that come in from the managing director of Nestle India. He himself is talking about a struggle, and he's not available cheap. So it's not that if I buy it, I may not fall. But my primary objective of investing is not to create a portfolio that doesn't fall. My primary objective of investing is to get capital appreciation. Within the capital appreciation, I should not fall. Or if I fall, which I'm not trying to shy away from the fact that we've all fallen, then we should not get wiped off to an extent that we cannot come back into the market.
Hope that answered your question, Nilesh.
Yes, Krishna. Yes. Thank you. Thank you, Safir sir. Thank you, Krishna, for the opportunity.
Most welcome. Then we have Karan, and then Chetan.
Safir, if you're looking at certain sectors from a 3 to 5 year horizon and not specific stocks, but maybe a basket or a sector per se, any thoughts there that you would like to share with us that you think are going to do better than the rest of the lot?
I personally believe the fact that while the market may be temporary in the moody phase, and therefore in the moody phase it may have knocked out some of the IT players, the level of business that lies ahead of them is huge. I mean, if you actually look at it from many perspectives, there is a digital onset. Today, the digital onset was led by new tech companies. It was led by banks. Now even some of the traditional companies that may be making cement or maybe doing some a toll booth or looking at the efficacy of a commodity that they produce are trying to bring in technology and move into digital space. Even startups want digital, mid companies want digital, payrolls have to be digital. I the other day was part of a presentation made by a company, I'm not going to name it. They were mapping every single movement of a truck from one factory to another, every single shop's offtake, etc., because they were putting ERP to a best form. So the movement to digital, the movement to cloud. Now look at the extent of movement that is going to happen in cloud. Then look at the extent of level opportunity that has to come in. Cars are no longer the cars that we used to drive when we were kids. The cars today are nothing but gizmos. They are beautiful IT infrastructure. It's like sitting in an IT room. It happens to go on the road. It happens to do a lot of things, right from the displays of the car to the entire mechanisms to the way they control alternate and the current flow, and whether they move from petrol to hybrid to this, the amount of motors that exist in the cars in order to make functionality. There are huge opportunities that exist across the IT spectrum. And today, everybody construes IT to be an instrument in order to capture efficiency. So, by buying IT companies, you are capturing efficiencies, you're capturing customers, you're capturing lack of leakages or whatever XYZ into your systems. And therefore, and that is an ongoing thing because it requires an annuity, it requires a maintenance contract, then it requires an upgrade. So that and look at the onset of social. If even social platforms like an Instagram or now say WhatsApp business, etc., are going to become instruments of commerce, again you have to go back to IT. So I think that the longevity of this sector right now is very, very apt. It's showing in the job market. It is showing India, and also India has the skills. We were always good in software and maths, and we are given the opportunity, and we are sort of stabilizing now. The only small debate that you will have is what will this currency do, X, Y, Z. And my belief is that a lot of these industry players, they have gone through a lot of movements in currency. There have been times when, for example, they have been knocked out because of currency movement, etc. They are relatively more prepared. They know how they have to price. There is a genuine demand. Read the commentaries from even the international players, the extent of demand that is being created. We are truly a globalized world, and therefore there's cross selling of these services happening all around the world. We are in a collaborative model where two people may collaborate. It's not surprising tomorrow if Infosys and Wipro jointly collaborate and develop something. There is a demand coming from the government. After all this entire move that they're doing from Aadhaar to UPIN to XYZ, every single transactional that I have to do in my life today, I feel I'm only doing it. So, but what is enabling me? It is only getting enabled by technology. So I believe, and then it's an export story. That's another plus sign, because we are making our industry more competitive, and it becomes an export oriented story. So the government wants to discourage imports, which is understandable, but it wants to encourage exports. So when it wants to encourage exports, again, what will happen is even the debates on whether the foreign companies will set up, say centers in India. So the government comes up in the budget and says data centers will be given infra status. That infra status, if it is given to a foreign participant to come in India, what stops Infosys and TCS and Wipro and HCL Tech and Tech Mahindra and whatever names you want to add, Emphasis and Mastech and Mindtree, Ventree, everybody from doing whatever they want to do? Why will they lose their edge? So that, according to me, is a good sector. The second sector that I really believe in and I've been investing is the banking sector. I personally believe, and I, at the risk of being wrong, so far right, but at the risk of being wrong, I think that the fintechs that are coming into the equity market at exorbitant valuations, and this I had said even earlier on the eve of some of the IPOs, they are actually going to benefit the banks. They will strengthen the banking system rather than weaken it. They are only intermediaries. And I feel that the banking system is coming out from a huge NPMS. It is coming out from a low credit cycle. It is coming out from lack of appreciation for, because you didn't like the service of the bank, the way the structure was, etc. But that is being replaced again by technology. Today it's at the push of a button. Now you can argue that the service of one bank vis-a-vis the app of another bank, you don't like it, one hang. But in reality, see, what those apps are doing. Look at the size of that. Look at the ability to reach. Look at what the RBI is saying, that in certain areas where internet connections are not available, we will allow transactions up to 200 rupees to start with. Money to bank से आएगा ना, या बैंक में ही जाएगा. I mean, I'm not saying you can put it in a wallet, but even a wallet will have a limited functionality. At the end of the day, what is the wallet going to do is, you'll again go back to the bank and say, I need a loan, I need to get an interest, I want to make a fixed deposit, I want to do a foreign remittance. So many certain things will happen. So they appear to be, and while we criticize the finance sector for a lot of valid reasons, including things like scams, etc., that have happened, don't forget the largest institutions in the world. Right from, you look at America and look at the financial giants that they have created. Look at the size of those financial giants vis-a-vis our own situation here today. So that, then the betterment of the medical facilities, and I think Dr. Tanmay will be able to elaborate more on this. We in India do not have the kind of medical facilities because simply we were not creating an opportunity for the entrepreneur to create it. It did not matter. Like, for example, when I was a child, I could have gone to my local colony doctor and said, Bukhar hai, and he would have taken the thermometer and put it in my mouth and taken out a stethoscope and done something and written for some form two of medicine, and I've gone and taken that and fine. Today I'm not in that mode. Today there is dedicated technology. We have done a lot of brain drain, and some of the best doctors in the world have come from India. Because they didn't find the need to be in India. Now some of them are coming back into India, and they're somebody's setting up a cancer hospital, somebody's doing a brain thing, somebody's, so MRIs come up in a big way. Technology is enabling a lot of things. People will move on. They will find the reason to do this. Now, where the affordability is a problem, they will do it remotely. They will say, okay, we'll break the entire treatment into parts. You can go to a cheaper diagnostic center. You can have an access to a high-end doctor by virtue of a remote call that you can make. That is, you take an online appointment, or you have a sort of a dedicated thing. Your reports can be stored electronically on a vault, which a lot of these hospitals and all are creating now. For example, if I go for a checkup, my doctor already has access to the reports. All he has to do is to generate an OTP, and then he gets access to my reports. I don't have to carry all my files, etc. If I was to go for a general checkup, etc. E-pharmacies are coming. Pharmacies are getting much more organized. Counterfeiting of drugs, if it is addressed in India, it's going to be the biggest growth factor. I don't think that in perpetuity nobody is going to do anything about it. See, look at our medicines. You go to America, you buy a medicine, look at the kind of safety locks it has. You look at the level of prescription. India has not reached that stage because जरूरत नहीं थी. We cut a medicine, हम एक गोली दे देते हैं. We are the only country that cuts a patta and gives it to you. Therefore, for the counterfeiter, it's even easier. He says if you have to deface the entire packaging, then it's very difficult. I'll get detected. Just day before yesterday, an article has come out that in one of the countries around the world, I forgot which country, I'll tweet about it later. I think yesterday, that the entire supply of the COVID medicine that are reached there is counterfeit and it's come from India. But nobody is bothered to sort of do this. But this will change. More than 70% of the revenues of the pharma sector are lost only because of counterfeiting. And you look at the size of that 70%. So when these changes come, there'll be a lot of catalyst. And why the changes come in? Because now you are a credible shop, you're a good chemist, you've got an air conditioning, you don't have expiry drugs. You basically follow a good prescription by saying who give you a recommendation, what is your mobile number, I want to add it into my system. I will create alerts, I will send the medicines to your home. So all this transformation that happens in the healthcare segment will be a huge opportunity ahead. So the point is again the benefit of one thing. And now look at e-vehicles. Now forget when it's going to come. Do you know the size of the replacement market? Like if you look at the entire size of cars in India, you look at the size of trucks in India, look at the size of three-wheelers in India. Three-wheelers are meant for supply of so many products. And now you come and say, I'm going to transform these and I'm going to make them whether it happens in 22, 23, 24, 25. But look at the sheer size. The only difficulty is that if you're an established player in the automobile market, a market leader, you are going to cannibalize your own sale because you already have a market share and you have to replace your own petrol product with the e-product. Therefore, new leaders are likely to emerge there, and those new leaders can disrupt the market in a big way. When they disrupt, they will create demand. What will they create demand for? People who provide ancillaries. And therefore that industry itself will become a very large focus industry. If you actually see even in PLI, a lot of companies that have applied are from the auto ancillary statement. Now I don't own stocks of Bosch, but doesn't mean I don't listen to the management of Bosch when they come and talk about the huge investment that they're making in India. Or for example, a Schaeffler who came and declared results and they spoke about a huge capex. Or why is a company like SKF Bearing saying that the best 3 years are ahead? We should give some importance to what they're saying. That 1 year can be 2 years, can be 3 years, but it's not. Or Timken. I'm just giving all the 4 players that I've named. There's nothing left now in bearing. Well, they're all talking about the same thing. You think today, okay, Butterfly, whatever company, I don't own that stock, but there was an announcement that the company is for sale. Why did Crompton and Havels bid for it? The Crompton and Havels are not silly that they feel that no, the white appliances market is stagnated and there will never be a growth. They know the huge potential that rural India holds. We're still in a situation, look at it today, you're crossing a village, they don't even have a fan. So at some point they will go to a fan. And look at the amount of people that will have a fan. After all, don't forget that India now has power. India supplies power now. We are not sitting with the situation ki batti nahi ab, and everything has to run. So when they'll have a fan, after some time they'll have, for example, an air conditioner. After all, if it came in urban India and you have found air conditioner everywhere, it'll come in rural India also. Because there was no reason to buy it when they had no bijli. Now they have bijli. And they have the affordability. Because it's by eliminating a lot of middlemen out of the farming sector, or by ensuring that there is going to be more organized sectors like direct from farm, organic foods, export opportunities, better warehousing, reduction of wastages, pilferages, oversized trucks, and the intervention of court to say that is not safe, and all these are all going to be great opportunities. Warehousing, logistics. How can we have the growth of e-commerce in our country without logistics? So there'll be great opportunities because India ke andar, look at the size of the country and the opportunity it holds. It's a simple description. We are not in terms of infrastructure, and I'm very proud as an Indian, and I would I'm not saying it in a negative way, but we are not commensurate to the infrastructure of where the rest of the world is. Today, if you look at the milk industry, and I don't own any stock, I'm just giving examples. The milk industry requires refrigeration. The refrigeration capabilities were not there. Many years back, I was doing a legal matter for Hindustan Unilever to do with quality ice creams. So we had gone into court to try and stop somebody from, making fake ice cream. So the judge asked us, do you supply your own genuine ice cream there? We said no. So the judge said, why don't you supply? So we had to explain that to buy a refrigeration unit where the ice cream has to be kept at a minus 18 degrees, minus 20 degrees temperature, itself is a cost about 8 lakh rupees for one outlet. So if my ice cream does not have the demand of 8 lakh rupees, how do I develop that infrastructure? Today that may change, because you can find that innovation is creating. After all, don't forget, like Cadbury created that one small box now where you put all the chocolates. Why? Because they had a contamination problem, and Mr. Bachchan had to come and say now there's a double foil, etc., etc. We all remember the Cadbury controversy. So the change there is going to be genuine, and that change is a huge catalyst for multiple opportunities that may emerge, because these are very large industries.
Thanks, Safir. I think you've given very elaborate views about all of these different sectors, which the audience has greatly benefited from. One question that seems to be coming constantly in the DM from people who are not able to come up on stage themselves is around the ethanol sector and this whole ethanol transformation. So, would you like to share your comments on how you see this whole thing playing out?
See, but there's a difference when you have entered early and you're sitting with gains, and a big difference when you are entering now, because of a very simple reason that ethanol is a push from the government. That push from the government has resulted in a lot of collaborative efforts between the sugar companies and the oil companies, that is the oil marketing companies, and the end result. But today there is also a situation that some of these stocks have moved up. So if I have bought, as an example, a company at 100 rupees and today you want to buy it at 400, my level of safety is very disproportionate to your level of safety. Because, and why am I calling it a different level of safety? Because if something was to go wrong, I will still end up making money and exiting. But if something was to go wrong, I'm not sure where you will head. So, and why is there uncertainty vis-a-vis you compared to me? Because right now, it's the market has reacted to the ethanol story very well in the last 6 or 8 months. This is not to say that I have sold of any one of my shares that I have on the ethanol side, but because when the market reacts very fast, sometimes you want the company, you want a few quarters to go by to see is the story going to actually become as big as it can. And are there going to be any restraints? For example, let's take an example, and I'll just give an example. If you read the annual reports of some of the companies which are not even into the business of sugar, even they are setting up ethanol plants. So I don't want to jeopardize the situation where you discover that there is now too many people have gone into ethanol. Meanwhile, hydrogen has come. Meanwhile, for whatever reason, some other alternate fuel has come, and then what are you going to do with this? Because the idea is only to sustain an environment. So buy it if you have to, but buy it in moderation. If the story gets better, keep building on the conviction. If the story stagnates, you don't lose, because zero is better than negative. Can you hear me?
Yeah.
I don't know. Some messages come. Some previous space crashed. I don't know. Somebody just put up a message. Anyway, so buy it in moderation, and if the story deteriorates, then you are also not subjected to too much. Now look at the dynamics of the market. I'll just give an example that in the morning, Balrampur Chini had cracked to 370 or 350. I don't know, some crazy price. It was down some 7-8%. And at the end of the day, it had recouped. Now, relative to the market where the mid caps and the small caps were down 2%, a certain currency, when it does not fall, becomes more expensive vis-a-vis other currencies, unless the currency is so stable and it has got so much of certainty that, and you are so sure about it, that you come and say, no, it is worth the relative premium that it commands. That is what the concept of opportunity cost is. In economics, we were always told that you have limited resources. The resources have got unlimited use, because every resource can get into something else, and you have to make the most optimum use. Like you have money, you have limited money, that money is capable of multiple uses. You can go and spend it, you can invest it, you can gift it, you can whatever, lose it, you can do something, but you have to put it to the most optimum use. What is the most optimum use? If you're hungry, the most optimum use is eating food, or thirsty. But on the, or if you are want to be celebrate, you want to celebrate by hosting a party, is it the most optimum use? Well, it depends upon how important that party is to you. Another guy says, I want to invest and I want to save. Like, take my example. I suppose I have a portfolio, and today my portfolio is worth say X rupees. Now, knowing that human life depreciates every year, and every year you're going closer and closer to eventually the end of life, should I be putting that money to better use by improving my lifestyle? Or should I just believe in a bank balance that at one particular time I will finish my life and the money will remain and it will go in the hands of the next generation who may or may not be capable of managing it? It's just a thought process. So you have to bring a balance in your life. For example, I don't compromise on enjoying my life. If I have to travel, I will travel. If I have to buy a car, I have to buy a car. If I have to go and stay, eat a meal at a hotel, I will eat a meal at a five-star hotel, because I do not know. But at the same time, I will not overdo it, because I like the fact of investing. I need the surpluses. I need the savings. It's good for my mind, if nothing else.
Absolutely. I think those are really important pointers that we need to keep in mind when it comes to, the journey of investing, uh, going from step to step, evaluating where and how, capital allocation needs to happen. Because at the end of the day, the capital is the same all across life, and all the capital is not only investment capital, but it's also capital to invest in your own experiences, in your own life, and in your own fulfillment at the end of the day. Because as investors, we don't want to invest in everything else besides ourselves. We also want to invest in ourselves, and we also want to, focus on our own growth and our own development, and see uh, how that makes us happier and more evolved as people. With that, let me pass it on to Chetan. But before I do that, it seems like a bunch of people are still trying to get into the space, but they're using the wrong link. So, guys, just to ask the listeners for a favor, I've put up the link to the space that we're using right now. Please retweet it so that other people can find it. I'm not able to reply to all the people in the DMs who are who are still searching for the link, but if most of us retweet it, it will automatically reach out to the people. With that,
So what is your tweet? Where is your tweet? I can't find where is your tweet. You just put it up right now?
yeah, the one that starts with previous space crash, please join here.
Okay, the one that I see on your Twitter just says if you haven't joined the space already, you're missing out.
Yeah, that one's also fine, and any link, any of the recent links will work.
The one that you retweeted, right? Which is from Delhi Investor. I'll just retweet that.
Yeah.
Okay, I'll just say link to join. Done.
Thanks, Safir. Chetan, please go ahead and ask your question.
Hey, hi, Sahir. How are you, brother? Hello, Safir, sir.
Hi, how are you?
I'm fine, sir. Just wanted to ask this question, sir, that in last 4.5 months, FIAs have sold more than 1.62 lakh crore worth of stock. So first question is, what do you make out of it? And the second thing is, I also track lots of results of the companies, and the results which I've tracked, the results are very good as per my analysis. The only problem was with expenses and these raw material cost price inflationary pressures. So I just wanted to know from you that what do you make out of it, and these institutional sellings. Thank you.
So I don't make out anything negative about the institutional selling, and I will explain to you the rationale of that. That notwithstanding the very high selling by the FIIs, which I do not debate because it is a fact, that amount of selling is very disproportionate to their ownership of the Indian equity, even after all this. So it is like if I have invested, say, 1,000 crores into the market and I pull out 2 crores, you cannot say that by pulling out 2 crores, and that too are in a situation where typically some of their holdings may not have appreciated. For example, they own a lot of Kotak Bank and HDFC Bank, which have not really appreciated in the last 1 year. They're actually pulling out that money because it may be a part of a scheme of many things. For example, the appreciation in the Indian equity market between March 2020 and now, on their overall portfolio may have increased their India exposure. Many of them follow MSCI balancing and FTSE balancing. Some of them may have made investments in other parts. Don't forget, the US market was extremely buoyant during this point of time, and it is, for many of these FIs, it is a homegrown market. In India, they found a lot of opportunities to invest in IPOs. Some of the IPOs, they would have now burnt a lot of their money, but at that time when they invested, there was an outright frenzy. A lot of money is going into the private equity space, because let's not forget that in the private equity space, and we see all these unicorns and we talk about unicorns, but most of the unicorns are funded by foreign money, and the foreign money has got the same color. The color of money doesn't change. So there may be many reasons for them to have adjusted to this thing. The FIs will come back. It is not now when they come, whether they come back tomorrow or they come back after a week or a month or they come back after 2 months is not my guess, because I don't have the competence to assume that. But they will inevitably come back. And when they come back, the question is, usually when the FI buying starts, the DI selling starts. It is not that the DIs at that point of time are also buying. The DIs are bought and they also like to encash at that point of time, unless the retail participation remains very high, in which case if the DIs and the FIs are both buying and the market goes into pockets of exuberance because there's too much of money chasing stocks, then it becomes a problem for the fund manager to generate returns, which is what some of the leading fund managers say. They say, you give us so much of money at the top of the market and you withdraw it when it falls. Like, I'll give you an example. If right now you say mid caps have corrected, say 20%, how many people are deploying money in mid cap funds? How many people are giving money to small cap funds? That's the problem that happens, because that's the mindset. We like to just chase momentum, and the moment the market corrects, we just want to withdraw. You'll do very well even if you're holding. So that is the first answer, and I'm not so perturbed by the FII movement. I'm also see some of it, while we are also seeing a complete transformation of the investment fraternity in India. The investment fraternity in India is getting relatively more mature, thanks to forums, thanks to reading of books, thanks to exposure. Now it's not, see, when the market cracks, as an example, today if the market in the morning was down some 1,300 points on the Sensex, the retail did not panic. Many people were saying, okay, we will buy a little bit into our favorite stocks, and which is the correct way of investing. Now, why the 1,300 points recovery became 300 points recovery, whether it happened by retail, whether it happened by domestic buying, or it happened by FII covering, is a very difficult phenomenon to understand. See, by the way, let me tell you something contrary. The FIs are not sellers. I don't agree at all with you, because the FII net pulling out of India, which looks very large to you, is very small compared to the amount of money they pulled out from the rest of the emerging markets. Net to net, India still got $2 to $3 billion, which may seem smaller compared to the past. But add to this all the IPO money, private equity money, this money, that money. Like, for example, if somebody says, okay, I've subscribed to now some of these private equity funds that have come in, some of the REIT money that has come in is also very large, no? After all, don't forget, some of these FIs themselves have become REITs, no? Bridgestone आ गया या वो so not Bridgestone, it's called what is that beast, I forgot the name, the big real estate guys. Blackstone आ गया country में, या Blackstone आ गया या कोई आ गया. They're also very big, no? It's not that they have just changed their model. And where are they? And okay, if you see in towards the last part of 2021, many of the FIs downgraded India. So when they downgraded India because they felt the valuations have gone up, maybe they want to buy the market, but the market is not coming down. Maybe they're wanting to buy the market. Now I'll give you a test of this. In between block deals happen, they just mop up everything. The block deal comes, everything gets picked up in a matter of minutes. So how does the block deals happen otherwise? while I'm telling you that HDFC, as an example, HDFC Bank has underperformed the market, tomorrow BIS make an announcement that HDFC's for FII holding is available. I think in a matter of 1 minute, they'll take it. So that is the nature of their thing, and I don't think we should attach too much importance. What was the second question? Sorry.
That was just about these inflationary pressures and the margin pressures on the companies, and how do you make out of these results, the companies which have shown the Q3 results?
So inflation is not bad for stock investing. There's a difference between inflation vis-a-vis stock investing and inflation vis-a-vis the manufacturing. Because in inflation, when the asset values also have to inflate, no, that's how it is. As long as you are able to inflate the asset values, it is also good. For example, if I have real estate and there's inflation, the real estate value will also go up. Now, what happens is that in inflation, currently the problem is that the raw material side is being impacted not by inflation, it is being impacted by logistic problems, by supply chain disruptions. The supply chain disruptions are happening particularly because of semiconductors, or because of, depending on what your ingredients are. For example, there may be a restraint in terms of your ingredients. Sometimes the warehouses are not available. The ships have got impacted. The Baltic Index, in between at the Suez Canal had got blocked, and many other similar things. The aviation sector was not fully functional. So many flights were only able to bring necessities. So when the supply side has been impacted, inevitably the rule of economics is that if the demand is more than the supply, then more people will jump in order to produce. That's what happens. Capacity expansion goes up. That is why I'm saying that it is a genuine probability that the capex cycle in India will turn. Even on the semiconductors, you will see that there are so many announcements made in the last few days that XYZ company will come and set up a semiconductor operation in India. So over a period of time, these inefficiencies of one kind will get reset. And once they get reset, I don't think that the raw material problems will last the way the market is behaving, that they will last. In fact, the CEOs don't believe that they even see. Sanjeev Mehta of Hindustan Unilever is a very, very honest and a very straightforward person. Please hear his interview that came out a few days back. I think it was either as CIA president or FICCI, whichever role he's in. He made a statement that no, they don't expect this to last. And I have no reason to disbelieve him, because it seems very logical. See, also try and understand that every transformation causes a new gap. The new gap creates a new opportunity, and it moves into a new growth orbit. For example, when the lockdown happened, let us assume, I'm talking from my own experience, let us assume that as I became, obviously all my work started happening on a digital mode. When it happened on the digital mode, efficiencies of time set in, because I was able to finish one call, start the next call within 5 minutes. So typically when a client would come to meet me, he would have to wait, I'll have to travel. My expenditure on travel got completely replaced. I used to do a extensive travel all around the world. That amount got replaced. The paper cost got saved, because a lot of things are not being produced on paper. But there was use of more bandwidth. There was use of more, for example, encryption, security, digitization. So the nature of expense will keep changing, and when that changes, it will always create opportunities. Now, if you look at it logistically, I mean, that is by common sense. If the paper consumption fell because schools and colleges were closed, offices were closed, then why are companies in the paper sector reporting higher profits? Because the inefficient ones got wiped off, and the supply side did not get increased. So when the supply side did not get increased, then what happened? Somebody would have said, I need specialized packaging, which needs paper. Somebody says, I need recycling, it needs paper. Amazon says, I need this particular kind of paper because I have to deliver logistics, it needs paper. It got repositioned. So if you were doing photocopying, you moved to craft paper. China started importing. Somebody said, now I'm fascinated and I will launching my business, and for that I want to send invitation cards and I want to send XYZ, whatever things. Nature kept changing. So that's the nature. So you have to keep finding the opportunity, and placing your investment bets in a staggered manner based upon where the opportunity lies. Inflation is not going to kill a lot of businesses. It will readjust.
Thank you very much, sir.
Also, I don't think the monetary banks in the world which are aware, right, see, RBI is aware of inflation. RBI has done a great job about to whatever extent with all this volatility around the world. At the same time, all the world banks keep sitting and keep talking about inflation. So right from the US where to United Kingdom to India to other places, they're all going to monitor it and they'll probably take steps, which is what they've been doing for such a long period of time. It's just that sometimes the nature of steps may be very different, and therefore somebody will come and say, but I have no scope left right now on interest rate, so I must do. See, quantitative easing was also an unprecedented event. Huh? A lot of inflation has come in by the circulation of money in the world. Now, if that money is going to be sucked out, then it is not that the inflation has to be high. The inflation will also reduce if it was caused by one thing and that thing is taken out. It should readjust according to that also, no?
Absolutely. I think the amount of money supply that comes in itself creates a lot of inflation, and this is something that we all as investors have to take into consideration, the way in which that money supply is going to affect inflation. Where in the process of product development is that inflation going to take place? Is it going to be raw material inflation? Is it going to be logistics inflation? Is it going to be intermediary inflation? Is it going to be inflation that can be passed on or not passed on? And I think all of these questions are questions uh, that are specific to the kinds of companies and the kinds of sectors that you invest in. And you have to sort of analyze and become a business analyst as much as you become a quantitative analyst, because the whole picture is not going to be shown in the numbers. If that was going to be the case, then investing would be far easier than it is. That being said, let me just welcome Glaston. He's been waiting very patiently to ask a question. Glaston, you can unmute and ask your question.
Thanks, Krishna. Hi, Safir. It's wonderful to listen to a market veteran sharing valuable insights and experience. Uh, I'm curious to know about an interesting idea that you had tweeted few weeks ago about a small microcap company, Swiss Military Consumer Goods. Would like to know your approach while you decide to invest in such unknown companies like Swiss Military or maybe like RACL Gear Tech in the past, which has also been doing great, performing greatly.
See, I will comment generally. I will not comment on the specific script because one script you may know about, so many other scripts you may not know. If today I may be invested, tomorrow I may not be invested. Today my rationale may be based upon certain premises. Tomorrow the companies may do something different. And because we are not sitting in a situation where, on a day-to-day or minute-to-minute basis, I'm giving you inputs on what I own, etc., it may be a very distorted information unless you are completely attuned to what is happening. That I'll give you an overall rationale. See, my portfolio is classified between large caps, mid cap, and small caps. There is no fixed formula where I say 33% has to be large cap, 33 mid cap, and 33 small cap, because that will depend upon the opportunities that exist. While you may have picked up two examples of companies that are small caps, many people are aware of the fact, and from my previous writings for Outlook Business and I think one more publication, my picks was at that point of time was an ultra large cap bank, which initially was ICICI and then became State Bank of India, and I'm both invested in both those counters. So the point that I'm trying to make is that when I look at a company, I have to look at where the company will lead me, whether that company is transforming, whether commensurate to its valuations, book value in the case of banks, or for example, the profitability or whatever opportunity size, export size, transformation, etc. Is it commensurate to the market cap? Because why do I pick up large cap? Because they have stability and they have the ability. They already established leaders, and if the leader has been dented, it's like a zakhmi share, then it has the ability to come back and roar. And the transformation in the management, for example, State Bank of India's app itself is called Yono, which basically means you only need one. That's an acronym for YONO, and that itself is a very positive sort of an affirmation that they have made, and a great from the perspective of the fact that it is an in-house created app. It's a great thing that they've done. ICICI may have gone through a complete transformation. If you look at the graph between them and HDFC, they were continuously losing opportunities. And now even somebody as credible as a Kotak Bank has applauded them for their efforts. So that's on the large cap. When it comes to a mid cap segment, mid cap companies are, once they have reached a certain traction level, they have gone through a lot of cycles of ups and downs. And when they have when they have lasted in those cycles, then they reach the ability to move to the next orbit, which is what, as an example, Mr. Ramdev Agarwal talks in his study when he says that in his case, he likes to buy companies once they have reached the mid level, not the small level, because the level of destruction may have been done away with. Many of these companies will not go to zero, so that brings in a level of comfort. Why do I buy small caps? Because in reality, it is a small cap that gives the highest return if you get it right. Because obviously, the market cap is so disproportionate that if the company gets it right, then it can become a very large return stock. Now, what do I look in these companies? I look at what is the company doing that is different from everything else. Valuation will come second. Valuation means I don't have to see whether it is cheap, expensive. Today, there may be a company listed in the market at a 70 PE that actually may be the cheapest company because it has undergone the worst cycle and therefore the earnings have been impaired. But there may be other companies that are at a 70 PE where they have not gone through a bad cycle, they've gone through their best cycle and perhaps are entering into a tough arena. So you will create a basket of stocks. In that basket of stocks, why do you remain diversified? Because it is very difficult to say that which one of these guys is going to be your best performer. If today one of the stocks that I own, which I am very happy did very well for me and is one of my largest holdings, did I know when I go back in time that it was going to become such a good performer? Well, not really, because at that point of time something else was outperforming in the initial years. Then, for example, I said it comes from an industry that has not been able to demonstrate wealth creation, except this company has created it in that industry. I do not know what the promoter will do when the market cap goes up. Will he be too obsessed by market cap? Will he do frequent dilutions? Many other things. Will he make bad choices? So that's why you create a basket. And if the story remains intact or it does not deviate substantially, then you keep on adding to that basket in order to strengthen your portfolio. Also, I do not bother so much on a company. See, people ask me, why do you own so many stocks? So I tell them, when the stocks are doing well, over automatically they're self-adjusting in my portfolio in terms of weightage. If my winners are becoming more heavy, then automatically they're getting adjusted. And what is it doing? That basically means that those which are not turning out to be winners or are relatively lesser performers, their value is diluting. When the value dilutes, if it becomes too inconsequential, then I have to look at that company and say, look, I invested money here, it's not worked out because my entire portfolio is done well or the market is done well, and there something wrong in my thinking, or is it just a matter of time? Because it's not necessary that the market comes and votes the same day. So if it is a matter of time and you believe that this company is transforming and the market may be at judgment, then you'll have to satisfy your patience by saying, look, believe in me. And if it is wrong, then it is a very small price to pay to exit that stock and to add to your winners, which is what I try and do. See, even today, I'll give you an example. Even I'm not going to name, but today also I would have done a little bit of shuffle in my portfolio. Now, if somebody raises a question and says, do you have a very high churning rate in the portfolio? By the way, just for information, I have one of the lowest churning rates in my portfolio. Because when I put a tweet that I'm buying and people say, what are you doing? Look at it from 2020 March to now. I think I've only exited 3 or 4 companies. And that 3 or 4 companies for a diversified portfolio is not much. Now compare it to somebody who's got a 12 stock portfolio who does 4 companies. He's done a 33% churn. My churning is not even anywhere close to that, because not even one of my winners I wanted to exit. The only difference is, if I bought a company A and that company A then went up a lot in value and it was likely to face a lot of competition because other players came in, or it started doing something which was not pleasing, or for like raising capital, doing too many conference calls, trying to talk the market up, or for example anything that you're doing complex acquisitions that I cannot understand, then I should be moving out because I'm being rewarded by the profitability to find the next opportunity. And wherever a gap is created, it will be filled in by a very articulate thought process. But if you're too overloaded, you will not have the ability to sort of explore a new idea.
Thanks, Safir. I think that also sets the record straight a bit, because people tend to assume that you have a lot of churn and that you go to cash. And I'm glad that all of those, sort of misperceptions have all been cleared out, and that understanding is clear around the fact that you have a low churn portfolio, and the sort of steps that you take while constructing it. I just
Well, I
wanted
never
to.
go to cash. Just to tell you, no, my cash, like in December, I went to cash. It would have been 3% of my portfolio. And what does that cash really do? When the cash is generated in my portfolio, for a few days, it gives me a lot of independence to think that I have money lying, and I'm sort of have I have the ability to find a new opportunity. Then my brain starts looking for that opportunity, whether it is by reading, whether it is looking at precedents or what is happening in the rest of the world, by reading the letters of a lot of international investors, because the industries there are much more. And then you start looking at examples in India. For example, suppose electrolyzers is right now massively in demand, and there's not a single listed company in India that makes electrolyzers. And if I find an opportunity, I will look at it and I'll say, is there an opportunity? Suppose I found a company that was making it, then I could have bought it if I believed that this company was good technology wise and opportunity wise. But if I don't find the opportunity there, then I don't have to force. So what do I do then after a certain point of time? Market, it's not as if in market all the horses are running at the same time. Some horses will be laggard compared to the market, somebody will fall because of some reason, etc., etc. Like I said, one quarterly result comes out as a flash on television, the stock is down 10%, you come and say, come on, that's too harsh. That company's management did nothing wrong, the management is giving good commentary, etc., and yet the market is being too harsh just because the expectations were too much, or it was like buy on rumor, sell on news, whatever, XYZ. Then I have that money ready to deploy. So I always will remain deployed, because my idea of deploying the money is first to beat the fixed deposit. I don't think it is so difficult to beat the fixed deposit by being invested, because mota, so you'll get dividend also. You'll get a capital appreciation also, because the market does go up. So it's not so difficult for me. And I do not have that mindset that I never go into this 20-30% kind of cash. I can tell you right now, I can decide tomorrow morning, you give me money, I can deploy it. The question is that you must have a ready list of what you want to buy. So what do I do? That's the advantage of smartphones. When I'm, for example, sitting in my car, if I get an idea, I open my notepad and put it there, or I write it on my iPad notes or whatever XYZ notes. And then whenever the money comes, I'm ready to deploy. The only time when I will not deploy is if that idea is moved up too much beyond my buying zone. And if it is moved up, but the opportunity has gotten better, then I will still buy it. So I don't have a price fixation. But if it is moved up just because the market has, like, suppose for some reason the market tomorrow goes up and all the mid caps are up 2%, then I don't have to wait, because I still don't know in one day is the Russia thing going to be decided or give me another opportunity. Because this is not an event, as an example, like a result, which is like more certain to assess. This is a little bit of a difficult event to sort of apply your mind to. But I'm never in cash.
Thanks, Safir. I think that was a really important perspective, and also gives people a bit of understanding around, how to think about cash. We have our last question from Parvez. Parvez, you can go ahead and unmute.
Yeah, great. Thanks, Clarence. Thanks, Krishna. Safir, lovely speaking to you again. I just heard you say about not being in cash and deploying your cash all the time and being in the market all the time. Keeping that in mind, what do you propose as a ideal portfolio? How many stocks would you prefer to have in a portfolio? Because if you're going to make meaningful money to have a concentrated portfolio with meaningful investment in there. And then, of course, diversify amongst the sectors and various caps, etc. So, just like to get to your view on what is the optimum portfolio that you would want to carry.
No, there is no right answer, because there are people in this world who have made money with concentrated portfolios. There are people in this world who have made money with diversified. I'm not anywhere close to that number, or even even a fraction of that. But Peter Lynch had 1,500 stocks and he was beating the market outright. There are people like Vanguard, they who run ETFs, and that ETF is running into so many stocks, and there are ETFs all around the world, and look at the kind of phenomenal record they've had. Now, let me give you a hypothetical answer to this. Suppose, as an example, I own 100 stocks, but I beat all the funds. How should I care? Why should I care? Because my role is that when something goes bad, and inevitably, it's not that things will not go bad. When something goes bad, how much will it harm me? Nothing. And what is market is not about getting it right. It is also about safeguarding yourself from getting it wrong. So let's take an example that I owned a stock. I'm just creating this. I don't own it, but let's assume that I own Dhani as an example. I'm taking up this stock because I'd written against it, but let me assume that I own Dhani. And it went wrong. And it was 1% of my portfolio lost to that one wrong. Then the 99 would have been able to subscribe me the way ahead. Now let's take another example that I own a good stock, and that good stock is at 1% exposure, and the company does well. It is my foolishness if I'm not adding to the positions while the company is doing well. So as the company does well, I get two benefits. One, that 1% allocation is becoming better. So example, it doubles, it becomes 2. But in the journey of that 1% becoming 2% or 3% or 4%, you're also moving towards those stocks. So as an example, one of my largest holding, not the largest, or one of my largest holding, I bought even in the last few days, despite the fact that the stock fell 0. In this entire market carnage, it hasn't fallen even 1 rupee. But I bought, because if I find that the company is doing, and I know that the weightage will go up relative. And see, also what happens is, when you have outperformers, the outperformers are themselves readjusting weightage, which means they're diluting the ownership of the underperformers. Now, when the market cracks, like it has right now, I have to pick up my portfolio and look at it as if I owned a basket of currencies. And now I find that there's some currency that has fallen because something wrong has happened. It makes my choice of switching so easy. It is not such an easy choice when you have to deploy money. Because when you deploy money, money is an absolute value. You have a 100 rupee note that you have to buy a stock worth 100 rupees. That 100 rupee stock becomes 90 rupees. You lost 10%. But when you're switching, it's not the same mindset, because you know that you're switching from one currency to another, of an underperforming category into a performing category, when the performing category is corrected. It's a very different mindset. And one of the reasons for success in investing is you have to continuously talk to yourself, and you have to tell yourself what is going to work for you. There are people who make great money in small caps. There are people who make great money in commodities. There are people who make great things in, for example, businesses that are very complex. And there are people who make great money in simple ideas. They can all work. So I tell myself this: any person comes and talks to me and says, but you own a diversified portfolio, I say, please bring me the best performing fund. Let's see whether we can beat the. And also, let me tell you something. The mutual funds themselves are so diversified. An investor
but
comes
Safir,
and
but
says,
we're not against the not fighting against or going against or trying to beat the funds, right? Because most of the funds, as you know, don't even beat the index.
no, but I'm giving an
So
example of the best performers. If the best performing fund is up 30% and you are up, say, 32, then how did it matter? Now the best performing fund falls 10% and you fall 12%. How does it matter? That's not relatively such a bad show. The question is that you must, when your conviction is working right, when your stories are working right, you also have to build up on them. It is not that you will remain static and you will say, I bought it once in my life, now I bought it 100, it become 200, so what? It become 400, so what? You will also keep adding, no?
yeah, that's where Buffett says, right? When you're so convinced and
and you've got a margin of safety, and you've got a great future ahead of the stock, and you back up your truck. And that's what I'm talking about, is a concentrated portfolio where you've got a pretty diversified portfolio, but it's concentrated so that you put meaningful money into it and you get meaningful returns when the scenario works out.
Absolutely, I disagree. Warren Buffett does not have a concentrated portfolio. He historically had a concentrated portfolio because he came at a time of baby boomers when the Great Depression had ended, and he bought sizable stake in companies like Coca-Cola, Gillette, American Express. But in reality, today he owns 110 companies or even more. And in reality, he does derivative bonds. And in reality, he's underperforming the market with his own newsletters. He's admitting to the fact of underperformance because of this. Warren, this morning I had to talk with one of my mentors, a guy I really respect, who's got more than 100 baggers. He doesn't even come on television for interviews. He told me that I've never met somebody in India who understood Warren Buffett correctly, and this man is the one who took Ramdev Agarwal to meet Warren Buffett. So you can understand Warren Buffett is so misquoted. Warren Buffett is not saying what you are believing him to be. He's basically saying that if you find an idea, your favorite holding period of the idea should be forever, provided that idea is working out, and then you can keep increasing your position and it will do whatever. He buys junk bonds also. He says the world says he's not buying technology. His biggest position becomes Apple then. And then
Yeah, that's because of Charlie Munger.
Yeah, but when he bought it, we said that it's not because of him, it's because of the two people working for him. Then he bought, for example, he he had one of the largest holding in that US. What is that company with the chariots?
Costco.
The finance company. Then scams happened there. So a lot of things happened in the market. Wells Fargo, when Wells Fargo went wrong, etc. The point is, and plus look at it. No, don't forget that his highest return came after 65 years of investing. So if I own my stocks in 60 years and I've created a portfolio and buy that, see, those were also companies that were very large American companies that became global companies. Like an American Express became global, or Coca-Cola became different. What was the big deal if you own Coca-Cola in the last so many years? How did it make a difference to you? Plus, let's not compare ourselves without taking into account that Warren Buffett has a constant source of cash flows, which is very critical, which is how he structured Berkshire and his insurance businesses. If you have that kind of money coming, if I'm a fund manager and every day I have inflows coming, then I'm able to build up a lot of positions. Now, Warren Buffett says that if I have this money coming every day, I cannot go with the pains of trying to own everything around town, because it becomes very difficult for me to track. Therefore, opportunities are rare. He repeatedly says that you do not get too many opportunities. But if he does get opportunities, it's not as if he doesn't invest, no?
Yeah, and many times he buys back his own shares also. And so, yeah.
Thanks, Parvez.
Thanks.
Safir, any closing thoughts before we wrap up?
Well, all thoughts are opening thoughts, not closing thoughts. They all open our horizon towards many things in life. So closing thought, there's no summary of what I said. It was a general sort of a discussion. I'm happy if somebody has a point and I can make a point on that, but I don't know what should I close it with, because it's not a conclusion. It's a work in progress.
Let me try and put in a closing thought that would encapsulate the magnitude of what you've shared with us today. So, guys, if you listen to the words and go beyond the surface meaning of what Safir has shared today, you will all have the opportunity to grow as investors. The differentiation of different companies and organizing a portfolio, the way in which Safir has shared it, is not one that you're going to find in any book or in any blog post. It's built with years and years of experience and insight, and it offers you as a listener the different strategic positions that you can take as an investor, and how Safir has successfully been able to combine those different strategies in order to generate a portfolio that would go ahead and do, uh, do as well as Safir has been able to do. Um, uh, what also really stood out to me in today's conversation with Safir has been his way of being of going beyond the letter and interpreting the giants like Warren Buffett and Charlie Munger, and uh, going beyond just what was written on the page to understand and collaborate that with his portfolio, with his letters, takes a lot of effort to be able to do. And he has shared those interpretations with us today for us to be able to benefit from that. He's shared a perspective on India and helped all of us as investors get a lot of strength in a moment which is generally filled with weakness in the market right now. I've personally got a bunch of messages during this chat, and I think one or two speakers have also come out and said how Safir has been a voice for reason in the middle of all this tumultuous volatility. And it has been fantastic to also understand Safir's opinion on the emerging sectors and the sectors he feels are going to play out going forward. Just a disclaimer before we close that nothing shared here today was investment advice, and please do your own research and due diligence, um, and only then go ahead and make whatever decisions you need to. With that, yes, Safir sir, thank you so much for coming out here. Thank you for giving me and Delhi Investors Association the opportunity to host you tonight, and we really look forward to hosting you many times more to come.
Thank you, everybody, and thank you for your time and your attentiveness. And good luck for recovery and better returns in the times ahead.